Most people think they know how the 2008 financial crisis started. They picture a wall of collapsing subprime mortgages, greedy bankers selling loans to people who couldn't afford them, and a single company, Lehman Brothers, going bankrupt in September and dragging the entire global economy down with it. It's a clean story with a clear villain, the predatory lender, and a clear turning point, the Lehman collapse splashed across every front page in the world. But here's the problem. That story is dangerously incomplete, and in some ways it's flat out wrong. The subprime mortgage crisis did not cause the 2008 financial collapse. Let me say that again because it matters. Subprime mortgages were the spark, but the real structural damage, the rot eating away at the foundation of the global financial system, had been accumulating for nearly 3 decades before a single homeowner defaulted. What actually caused the worst financial disaster since the Great Depression is a far darker, more complicated, and more human story than you've been taught. It involves a quiet legislative repeal signed on a Friday afternoon in 1999, a mathematical formula so elegant that Wall Street mistook it for truth, a Federal Reserve chairman who believed markets could regulate themselves, a rating system that was, in the most literal sense, being paid to lie, and a shadow banking system so vast and so unregulated that almost nobody in Washington even understood it, existed until it was already collapsing. The 2008 crash wasn't an accident. It was engineered piece by institutions and individuals who believed they were doing the right thing. And the most unsettling part is that many of the same structural conditions are quietly reassembling themselves today. So let's go back, not to September 2008, but much further, because the true origin of the crash doesn't start with a mortgage. It starts with a repeal. In 1933, in the wreckage of the Great Depression, Congress passed the Glass-Steagall Act. Its purpose was simple: separate commercial banks, the ones that hold your savings and checking accounts, from investment banks, the ones that gamble on securities and speculative bets. The logic was straightforward. If a bank's speculative arm blows up, it shouldn't be able to drag down the deposits of ordinary families with it. For over 60 years, that wall held. Then, in November of 1999, President Clinton signed the Gramm-Leach-Bliley Act, which formally repealed the wall separating commercial and investment banking. The repeal passed with overwhelming bipartisan support. Banking lobbyists had spent an estimated $300 million pushing for it throughout the 1990s. Citicorp and Travelers Group had already merged in anticipation of the repeal a year earlier, in a deal that was technically illegal under Glass-Steagall at the time it was signed. Regulators simply looked the other way, betting correctly that the law would soon change to accommodate them. Almost nobody thought this was the beginning of a catastrophe. Most economists at the time genuinely believed that modern financial institutions were sophisticated enough to manage their own risk. Alan Greenspan, who had chaired the Federal Reserve since 1987 and would continue for another decade, was perhaps the most influential believer of all. Greenspan was a devoted follower of Ayn Rand's philosophy of unregulated markets, and he held a near-religious conviction that self-interest among banks would naturally prevent reckless behavior, because no institution would knowingly destroy itself. That single assumption, that banks would never act against their own survival, became the philosophical foundation for 2 decades of deregulation. And it turned out to be catastrophically wrong, because the people making the risky bets were not the ones who would ultimately bear the consequences. Here is where the story gets deeply strange, and where most conventional retellings of the crisis miss the mark entirely. Once commercial and investment banking merged, Wall Street gained access to an enormous new pool of capital and a mandate to generate higher returns for shareholders. And they found their engine in something most Americans had never heard of: the mortgage-backed security. The concept itself wasn't new. Banks had bundled mortgages into securities since the 1970s. What changed in the 2000s was the scale, the complexity, and the deliberate obscuring of risk. Investment banks began buying up thousands of individual home loans, many of them subprime, meaning issued to borrowers with poor credit, unstable income, or no verified income at all, and packaging them into complex financial instruments called collateralized debt obligations, or CDOs. Here's the part that almost never gets properly explained. A CDO wasn't just a bundle of mortgages. It was sliced into tranches, layers ranked by supposed risk. The top tranche was marketed as nearly as safe as a U.S. Treasury bond. The bottom tranche absorbed losses first and carried enormous risk. The genius, or the con, depending on how you look at it, was that by mixing thousands of individually risky loans together, statisticians claimed they could engineer safety out of danger, the same way a single loose brick in a wall doesn't bring the building down. This mathematical alchemy relied heavily on a formula developed by a quantitative analyst named David X. Lee, called the Gaussian copula function. It allowed banks to calculate the probability that multiple mortgages would default at the same time, based on historical housing data. The formula was elegant, it was fast, and Wall Street adopted it with almost total confidence. There was just one problem. It was built on housing price data from a period when American home prices had never fallen nationally all at once. The formula assumed the future would look like the past. It didn't account for the possibility that if housing prices fell everywhere simultaneously, the entire premise of diversified safety would collapse because everything would default at once, together. The economist Nassim Nicholas Taleb would later argue that quantitative risk models like this one gave Wall Street a false sense of scientific certainty about events that were, in reality, fundamentally unpredictable, using historical data alone. Wall Street didn't just misunderstand risk. It manufactured a mathematical illusion of safety so convincing that it fooled the very institutions that were supposed to police it. Now, for these CDOs to be sold to pension funds, insurance companies, and foreign banks around the world, they needed a stamp of approval. That stamp came from credit rating agencies, Moody's, Standard & Poor's, and Fitch, whose job was to independently assess how risky a security actually was. But here's the conflict of interest that sat at the center of the entire system, and it's one that regulators somehow allowed to persist for years. The rating agencies were not paid by investors who relied on their ratings. They were paid by the very banks that were issuing the securities they were rating. Wall Street banks could shop between agencies, and if one agency's model produced a rating that was too conservative, the bank could simply take its business to a competitor willing to be more generous. The result was predictable in hindsight, and almost nobody saw it coming at the time. The vast majority of subprime mortgage-backed CDOs, instruments built on loans to borrowers with weak credit and often no proof of income, received AAA ratings, the same rating given to the safest government bonds on earth. A 2011 U.S. Senate investigation, led by the Permanent Subcommittee on Investigations, later concluded that the rating agencies had allowed conflicts of interest to corrupt their judgment, and that their inflated ratings were a direct contributor to the crisis. Internal emails from Moody's and S&P employees, later made public, revealed staff privately joking that certain deals could be structured by cows and still receive a favorable rating. This wasn't a case of institutions failing to see the risk. Internally, plenty of people saw it. It was a case of institutions being financially incentivized not to say so out loud. Meanwhile, on the ground, mortgage originators had every incentive imaginable to make as many loans as possible, regardless of whether borrowers could actually repay them. Because of the securitization pipeline, a mortgage originator wasn't holding on to the risk. As soon as the loan was issued, it could be sold up the chain to a bank, packaged into a CDO, rated AAA, and sold off to investors around the world. The originator got their fee immediately and bore none of the long-term consequences if the loan defaulted years later. This created what economists call a moral hazard on a massive scale. Loan officers began pushing what the industry euphemistically called ninja loans. No income, no job, no assets. Adjustable rate mortgages were marketed aggressively, with artificially low teaser interest rates for the first 2 or 3 years that would then reset sharply higher. Borrowers were often not clearly told what their payments would become once the reset hit. Between 2000 and 2006, U.S. housing prices rose by more than 80% nationally, and in some markets like Las Vegas and Miami, prices more than doubled. Homeownership was being sold not as shelter, but as a speculative asset that could only go up. And it wasn't just working-class borrowers taking on risk they didn't understand. Speculators and house flippers poured into the market, buying multiple properties with little money down, betting on ever-rising prices. By 2006, subprime and other non-traditional mortgages accounted for roughly 34% of all new mortgage originations in the United States, up from around 9% just 5 years earlier. Everyone up and down the chain, originators, banks, rating agencies, and to a significant extent borrowers themselves, was operating under the same shared assumption, that U.S. housing prices nationally do not fall. It was a belief with almost no historical precedent to challenge it, because such a collapse hadn't happened at a national scale since the Great Depression. And it was precisely that unchallenged assumption that made the entire system so fragile, because nobody had built in a plan for what happens if it turns out to be wrong. Now, let's talk about the part of this story that almost never gets its due weight: the shadow banking system. Traditional banks are heavily regulated and required to hold capital reserves against their loans. But by the mid-2000s, an enormous parallel financial system had grown up alongside traditional banking, made up of investment banks, hedge funds, money market funds, and off-balance sheet entities that performed many of the same functions as banks, borrowing short-term, lending long-term, but without the same regulatory oversight or capital requirements. Investment banks like Bear Stearns and Lehman Brothers were operating with leverage ratios that would have been unthinkable for a traditional commercial bank. By 2007, some investment banks were leveraged at ratios of over 30 to 1, meaning for every dollar of their own capital, they had borrowed more than $30 to invest. At that level of leverage, A decline in asset values of just 3 or 4% could wipe out a firm's entire capital base. Layered on top of this was an instrument called the credit default swap, essentially an insurance policy against a bond or security defaulting. The insurance giant AIG had sold enormous volumes of credit default swaps on mortgage-backed securities, collecting premiums for years while treating the underlying AAA ratings as gospel. AIG's financial products division, based out of a small office in London with fewer than 400 employees, had written protection on more than $500 billion worth of securities. Nobody regulated this market meaningfully. Credit default swaps were explicitly exempted from regulation under the Commodity Futures Modernization Act of 2000, another piece of legislation passed with broad bipartisan support and minimal public attention. This meant that when mortgage defaults began rising in 2007, the losses didn't stay contained within the housing market. They rippled through an interconnected web of leveraged institutions, insurance contracts, and derivative bets that regulators didn't fully map, and in many cases didn't even know existed at the scale it did. By late 2006, home prices in the most speculative markets began to plateau, then decline. Adjustable rate mortgages began resetting to higher payments, and delinquencies started climbing. In February 2007, HSBC announced it was setting aside thousands of billions in additional reserves to cover losses from bad U.S. mortgages, one of the first major public admissions that something was wrong. In June 2007, two Bear Stearns hedge funds heavily invested in mortgage-backed securities collapsed, wiping out billions in investor capital. Even at this point, most of the financial establishment insisted the problem was contained. In testimony before Congress in 2007, Federal Reserve Chairman Ben Bernanke suggested the impact of subprime mortgage troubles on the broader economy and financial markets seemed likely to be limited. It's one of the most quoted lines in the entire history of the crisis, not because it was malicious, but because it captures exactly how confidently wrong the entire financial and regulatory establishment was about the scale of what was coming. They weren't lying. They genuinely believed the shadow banking system was resilient, that the AAA ratings meant something, that the losses would stay contained to a relatively small slice of risky borrowers. What they didn't understand was that the entire global financial system had become so interconnected, so leveraged, and so dependent on a handful of shared assumptions about housing that a crack in one corner could bring down the whole structure. Throughout 2008, the dominoes began falling one after another. In March, Bear Stearns, unable to meet its obligations, was sold to J.P. Morgan Chase for a fraction of its previous value in a deal brokered and backstopped by the Federal Reserve. In September, the government-sponsored mortgage giants Fannie Mae and Freddie Mac, which together backed or owned roughly half of all U.S. mortgages, were placed into conservatorship. Then on September 15, 2008, Lehman Brothers, a 158-year-old investment bank, filed for the largest bankruptcy in American history. Unlike Bear Stearns, the government chose not to intervene, partly out of concern about moral hazard, and partly because there was no buyer willing to take on Lehman's toxic assets. That decision remains one of the most debated choices of the entire crisis. Just one day later, the Federal Reserve reversed course and extended an $85 billion emergency loan to AIG, whose collapse, officials feared, would have taken down banks and pension funds across the entire world because of its enormous web of credit default swap obligations. Credit markets froze almost entirely. Banks stopped lending to each other because nobody knew which institutions were secretly holding worthless mortgage-backed assets. The stock market lost more than half its value from its 2007 peak to its 2009 low. Nearly 9 million American jobs were lost. Roughly 10 million families lost their homes to foreclosure between 2007 and 2010. Global GDP contracted for the first time since the Second World War. Now, let me bring all of these threads together, because the true horror of 2008 is not any single cause, but the way multiple failures reinforced each other in a death spiral that no single policy change could have stopped. You had the repeal of Glass-Steagall, which merged high-risk speculation with the ordinary banking system that families depended on. You had a Federal Reserve chairman with a near-religious faith in self-regulating markets, presiding over the largest deregulation of finance in modern American history. You had mathematical risk models built on a formula that assumed the future would resemble a past in which national housing collapses simply didn't happen. You had credit rating agencies paid directly by the institutions they were supposed to independently evaluate, systematically stamping AAA ratings onto securities built from loans that never should have been issued. You had a mortgage origination system that rewarded volume over responsibility because the people making the loans bore none of the long-term risk. You had a shadow banking system operating with staggering leverage and virtually no meaningful oversight, and a nearly unregulated derivatives market layered on top of it, concentrating enormous, invisible risk inside a handful of interconnected institutions. And you had a regulatory and political establishment that, with genuinely good intentions in most cases, believed markets were sophisticated enough to police themselves. Each of these factors alone might have produced a contained financial hiccup. Together, they created a catastrophe that erased trillions of dollars of household wealth and reshaped the global economy for a generation. What economists and historians get wrong time and again is reducing this to a story about greedy bankers and reckless homebuyers. That framing isn't just incomplete, it's misleading because it implies the crisis was a moral failure of individuals rather than a structural failure of an entire system that had been quietly redesigned piece by piece over almost 30 years by people who mostly believed they were building something more efficient, not something more dangerous. When we talk about 8.7 million jobs lost or 10 million homes foreclosed, those numbers don't capture what it actually felt like to live through it. They don't capture the retired teacher who watched decades of retirement savings, invested conservatively in what she was told were safe funds, evaporate in a matter of months because those funds were quietly holding mortgage-backed securities she'd never heard of. They don't capture the families who moved out of homes they'd lived in for 15 years, packing boxes into a car. In the same week, the bank changed the locks. They don't capture the small business owners who couldn't get a loan renewed, not because their business had failed, but because the bank itself was suddenly too frightened to lend to anyone. In cities across the American South and Midwest, entire neighborhoods were hollowed out by foreclosure, block after block of empty homes with overgrown lawns, a visible scar that, in some communities, took over a decade to heal. Suicide rates and reports of financial stress-related health issues climbed measurably in the years following the crash, according to multiple public health studies conducted afterward. Millions of young adults who graduated into the 2009 and 2010 job market entered a labor force with historically low hiring, a setback that research would later show shaped their lifetime earnings for years afterward, a phenomenon economists call labor market scarring. And here's the thing that should unsettle you the most. Almost nobody responsible for these decisions went to prison. Not the executives who oversaw the securitization machine, not the rating agency officials who signed off on AAA ratings for securities their own staff privately mocked. The consequences of the crash fell overwhelmingly on people who had almost no role in causing it, while many of the institutions at the center of the disaster were, within a matter of months, rescued with public money and returned to profitability. This is a pattern that should feel uncomfortably familiar to anyone paying attention to the financial system today. The specific instruments have changed. Complex mortgage-backed securities have given way to new forms of financial engineering. Private credit markets have grown dramatically with far less transparency than traditional banking. And leverage has migrated into new corners of the system that regulators are still struggling to fully map. The underlying dynamics, however, rhyme in ways that are hard to ignore. Financial innovation racing ahead of regulatory understanding, risk being quietly transferred to whoever is least equipped to evaluate it, and a persistent institutional confidence that this time the models have accounted for everything. The conventional story of 2008 is comforting in a way. It tells us a few reckless people made bad loans, a housing bubble popped, and the system corrected itself. It implies the crisis was essentially contained bad behavior that we've since learned to prevent. But the real story is far less reassuring. The real story is that the crisis was produced by a system that had been deliberately redesigned over decades to reward short-term gains, while quietly transferring long-term risk onto people who had no idea they were holding it. The bankers who sold subprime CDOs weren't uniquely evil compared to bankers of prior generations. The regulators who deregulated the system weren't trying to cause a catastrophe. They believed, almost universally, that markets had become sophisticated enough to manage risks that, it turned out, nobody was actually managing at all. That's the real lesson of 2008. Not that markets crash. Markets have always crashed and always will. The lesson is that the difference between a contained correction and a global catastrophe comes down to whether the risk in the system is visible and whether the people profiting from it have any real incentive to tell you the truth about how much of it there actually is. So the next time someone tells you 2008 happened because banks gave mortgages to people who couldn't afford them, you'll know better. You'll know that was the visible symptom of a machine that had been quietly built, law by law, formula by formula, incentive by incentive, over almost 30 years. And in one form or another, pieces of that machine are still running today. If this story reshaped the way you think about the 2008 crash, take a moment and hit that subscribe button. We go deep on the forces that actually move markets, nations, and the global order, the kind of stories that don't make the evening news, but quietly shape the world you live in. Drop a comment below with your take. Was it the banks, the regulators, the rating agencies, or the Fed that deserves the most blame for 2008? I'd love to hear your thoughts. And if you haven't already, make sure to like this video. It genuinely helps the channel reach more people who care about understanding how money and power actually work. I'll see you in the next one.